Tax. Tax is a mandatory financial contribution collected by the government from individuals and businesses under the law. Earning income, making purchases, or owning property usually creates a tax obligation. The purpose of taxes is not only to collect money, but to fund public services such as healthcare, education, infrastructure, and national security. In the United States, tax collection is handled by federal, state, and local governments. At the federal level, this responsibility belongs to the Internal Revenue Service, known as the IRS. Most people do not directly notice the taxes they pay because many of them are built into prices. Sales tax is included when you buy goods at a store, and excise taxes are included in fuel, alcohol, and tobacco prices. On the other hand, income taxes deducted from paychecks or paid through annual tax returns are direct taxes. Taxes are generally divided into two categories: indirect taxes and direct taxes. Indirect taxes are easier to collect but affect everyone at the same rate. Direct taxes vary based on income and are designed to create fairness within society. The tax system does more than fund the government. It also influences behavior. Higher taxes discourage harmful activities, while tax credits and deductions encourage socially beneficial investments such as clean energy or business expansion. Taxes function as a shared public pool. Everyone contributes and everyone benefits. Bank. A bank is an institution that safely stores money, provides loans, earns interest, and manages financial transactions. Simply put, it is the center of the system that keeps money moving through the economy. Money kept at home does not contribute to economic growth. Money in a bank is constantly circulating. Banks collect deposits from customers. This money does not sit idle. It is lent to other customers as loans. Banks earn interest from borrowers and pay a smaller interest to deposit holders. The difference is the bank's profit. This process transforms savings into investments, turning one person's surplus into another person's opportunity. Banks also provide payment cards, wire transfers, currency exchange, investment accounts, insurance products, and digital payment services. This allows money to move across borders instantly. In the economy, banks act as intermediaries between savers and borrowers. Interest rates and lending conditions are strongly influenced by the Federal Reserve, the U.S. central bank. These decisions directly affect economic growth, spending, and inflation. In everyday life, banks operate quietly through direct deposits, automatic bill payments, credit cards, and mobile apps. They are rarely noticed, but they are everywhere. Banks are the circulatory system of the modern economy. Interest. Interest represents the value of money over time. It is the cost of borrowing money or the reward for lending it. When you lend money, you give someone the right to use it for a specific period. The extra amount you receive is interest. For example, if you lend $1,000 and receive $1,100 after 1 year, the additional $100 represents a 10% annual interest rate. This difference reflects the opportunity cost of money. You could not use that money yourself during that time. Interest operates throughout the entire financial system. Banks earn interest on loans and pay part of that interest to depositors. Governments issue bonds based on interest rates. The underlying idea is that money today is worth more than money in the future. Interest can be calculated in two ways. Simple interest is based only on the principal. Compound interest adds earned interest back into the principal, allowing money to grow exponentially over time. Interest rates are the heartbeat of the economy. High rates make borrowing expensive and slow spending. Low rates encourage borrowing and economic growth. Interest appears quietly in loan payments, credit card balances, and savings accounts. Invisible, but powerful. Inflation. Inflation is the general increase in prices over time. If the same amount of money buys fewer goods and services than before, inflation exists. This means the purchasing power of money is declining. If a product that cost $20 last year now costs $30, the difference is inflation. When price increases spread across many sectors, it signals rising economic pressure. Moderate inflation is normal in a healthy economy, but high or uncontrolled inflation reduces living standards. Inflation is commonly driven by three factors: increased demand, rising production costs, and expansion of the money supply. Inflation affects wages, savings, and investment decisions. That is why the Federal Reserve adjusts interest rates to maintain price stability. Low and stable inflation supports growth, while high inflation creates uncertainty. Inflation acts like a hidden tax. It reduces the value of money without directly taking it from your wallet. Recession. A recession is a prolonged period of economic decline marked by reduced production, lower spending, and rising unemployment. In the US, a recession is often defined as a significant decline in economic activity lasting several months or longer. During a recession, consumers spend less, businesses reduce output, and layoffs increase. Confidence falls and investment slows. This creates a self-reinforcing cycle that weakens the economy further. Recessions can result from high interest rates, financial crises, or global economic shocks. Governments typically respond by lowering interest rates, increasing public spending, and providing economic stimulus. A recession is like the economy slowing down to reset, risky, but sometimes necessary to restore balance. Credit score. A credit score is a numerical measure of a person's creditworthiness. In the United States, credit scores typically range from 300 to 850. Lenders use this score to decide whether to approve loans, set interest rates, and determine credit limits. Credit scores are based on payment history, debt levels, length of credit history, credit mix, and recent applications. Paying bills on time improves your score. Missed payments lower it. A higher score means easier access to credit and better interest rates. A lower score increases borrowing costs or limits access altogether. Credit scores influence not only loans but also renting, insurance pricing, and sometimes employment screening. They represent financial reputation in the modern economy. Value. Value reflects how useful, important, or desirable something is. Price is the numerical expression of value, but they are not always the same. Value is subjective and varies across people and time. Economists distinguish between use value and exchange value. Water has high use value because it is essential for life. Diamonds have high exchange value because they are rare. This contrast is known as the water-diamond paradox. In investing, intrinsic value refers to what an asset is truly worth regardless of market price. Value is influenced by trust, brand, scarcity, and perception. Price is visible, but value exists in the mind. Investment. Investment means allocating money today in order to earn more in the future. Saving preserves money. Investing grows it. Stocks, bonds, real estate, businesses, and alternative assets all represent forms of investment. Every investment involves risk and return. Lower risk usually means lower returns. Higher risk offers greater potential reward. Time is the most important factor. While markets fluctuate in the short term, long-term investing benefits from compound growth. Good investing is not just about profit. It is about protecting purchasing power against inflation. Investing means delaying comfort today for security tomorrow. Currency. A currency is a country's official medium of exchange and unit of value. In the US, this is the dollar. Currency enables trade, price comparison, and value storage. Currency values fluctuate based on interest rates, trade balance, confidence, and economic stability. The Federal Reserve manages money supply and interest rates to preserve the dollar's value. Today, money exists not only as cash, but also digitally through bank balances and electronic payments. Time. Time is the most powerful variable in economics. Money today is worth more than money tomorrow. This concept is known as the time value of money. Interest compensates for time. Investing rewards patience. Compound growth favors long-term thinking. Time gives meaning to inflation, debt, growth, and income. Time is an invisible currency. Once spent, it cannot be recovered. Smart investors manage not only money, but time itself.